Okay, welcome back, everyone. My name's Simon Johnson. I'm very happy to be on the co-chair of the Academic Advisory Board of Better Markets. And it's my great pleasure to be moderating a discussion in the next hour between two great experts on the questions of financial stability, past, present, and future. And we're hoping to have quite a lot of back and forth with the audience as well. So we'll let our distinguished experts have their say and then have plenty of back and forth questions as you see fit. My two speakers are, first of all, on my immediate left, Art Wilmarth. Art is an Emeritus professor from GW, George Washington University Law School. He's had a long and distinguished career writing about many, many different aspects of financial stability. And he authored quite recently Taming the Megabanks, which is a book we've been featuring today and we're promoting throughout. and on my next, two seats away, next left, is Professor Gerald Epstein from UMass Amherst, where he's a professor of economics and founding co-director of the Political Economy Research Institute. His most recent book that we're promoting heavily today is Busting the Bankers Club, Finance for the Rest of Us. So I have three sets of softball questions for my colleagues. First about history, the second about the current situation that we face, and the third about likely future. And I'm going to give them more leeway to be expansive on the answering the first question. Lessons from the past. And of course, we've had a number of really insightful discussions and presentations already today about various kinds of risks that we experienced in the past, various extremely costly disasters, including 2008, and measures that we have and haven't taken to get ahead of those problems. I did hear Art Wilmarth ask a question immediately before the break, which summarized in my own mind as, so this is deja vu all over again. But I think we need to drill down a little bit, Art and Jerry, which is which aspects of the past would you want us to focus our attention on in terms of lessons? Lessons, things we did right and things we did wrong, lessons for today and for the future. So lessons of the past is the first question. Art, what's your focus?
Okay, so my book really tried to look at the Great Depression and the global financial crisis and show the parallels between them. It was published just before the pandemic crisis started. And my subsequent writings, I've tried to show how the pandemic crisis, mirrors the other two in many respects. So I think, first what you see in all three, the 1920s lead up to 2007, and then the lead up to 2020, you see this very rapid growth in all sorts of credit, consumer credit, corporate credit, and then eventually government credit when the government has to step in and bail out the collapse of the private sector. So you see this rapid run up in credit. You see the banks funding more credit in the shadows. So shadow banks, shadow lenders start emerging in the 1920s. They emerge again in the 90s and 2000s. And then since the global financial crisis, as we just heard in the last panel, shadow lenders have been proliferating and expanding. So you see more credit being produced in the shadows, poorly regulated, not monitored. No one knows exactly what's going on. No one knows what the aggregates really look like and where the fragilities are. And then you see the big banks getting into Wall Street businesses. And what's the Wall Street business they love the best? Originate either directly or indirectly a lot of really risky credit, whether it's subprime mortgages, it's subprime auto loans, subprime credit card loans, subprime business loans, and then package them up into securities and in some way think that they're insulating themselves from the risk, and then selling it out to both institutional and possibly retail investors and saying, look, we're one of the top banks in the world. We wouldn't steer you wrong. You can trust us. So you had National City Bank, which was Citigroup, and you had Chase Bank, which was a forerunner of JP Morgan Chase back in the 20s as the leaders in this originate, securitize, and then, pretend that it wouldn't come back on you if it all blows up. But of course, it always comes back on the banks because they retain all sorts of contingent liabilities or reputational risks that they cannot ignore when the bust comes. And so the same dynamic of poorly regulated, unrestricted expansion of credit. You had very loose regulatory environments in the 1920s under Harding and Coolidge, in the 1990s and 2000s under Clinton and Bush. And then, obviously you had the first Trump administration loosening up before 2020. So deregulation is part of it, which feeds this cycle which of course creates an enormous credit boom. But when the bust comes, then you find out that people can't pay back the loans. And then there's a panic, and the pyramid starts collapsing. And then the federal government has a choice. Does it step in and bail out at least the systemically important people? Of course, it did not do that in 1929 to 33, and we had a catastrophic Great Depression. In 2007 and 9, they basically bailed out the systemically important people. In 2020, they actually bailed out everybody, including the fallen angels, including the corporate debt market. But this I'll save to the third question is, could we actually do another bailout when the next crisis comes? So I'll stop there.
Okay, thank you, Art. Jerry, over to you.
Okay, I also want to talk about bailouts. Bailouts are endemic to capitalism. Hyman Minsky said that financial instability is endemic to capitalism, and that the government always comes in and bails out companies that get in trouble. And he says, we should get used to it. And the question is, should we get used to it? And so what I want to ask is, well, despite the fact that we have all of these bailouts, what do they cost us? What are the costs of government bailouts? And we know that there are substantial financial costs. Dennis started off talking about the substantial financial and economic costs and cost to people of the great financial crisis. There have been estimates that the costs, there have been estimates by the IMF, the costs are often run from 6% to 15% of GDP and so forth. But these are just the, oftentimes just the financial costs. What about other costs of bailouts? Well, these have been really understudied, I think, by economists. So let me just list a few of them. First of all, there's one that I think most of us understand here, and that's the cost of moral hazard. That is the idea that if people and institutions get bailed out for activities where they impose costs on others, but they don't have to pay the price, they'll just do it again and at a higher level next time. And we clearly see that in what's been happening in our financial markets, where those that took high-risk activities in the great financial crisis and Silicon Valley Bank and so forth are still living to tell the tale and do it again. So moral hazard is a serious problem that creates the difficult problems for our economy. Second of all, a second cost is that evidence shows that after bailouts, the financial sector grows. It grows in size, and it tends to grow in terms of the more speculative margin of activities that it undertakes. What's the possible problems with that? Well, one is based on this literature from the Bank for International Settlements, the IMF, and others, who talk about too much finance. That is, there's a fair amount of evidence that once the financial sector grows to too large a scale, that it actually leads to lower economic growth. Other problem with the financial sector growing in size is that it's more prone to future crises, and that's more likely to lead to further bailouts. Now, there's some evidence that the financial sector grows in size in association with these rescues, with these bailouts. I think there needs to be more research on that to show the direct causal link, but I think it's pretty clear that after bailouts, the financial sector is much more likely to grow. A third factor, a third cost of financial bailouts is that it discriminates against those financial institutions that don't get bailed out. So if we're thinking about the community banks and other financial institutions that might help communities and workers and marginalized communities more, they have to pay more funds for deposits, whereas the large banks that get bailed out get subsidies. So it creates a inequality in not only the financial system, but who gets served by the financial system. And finally, just to list one more, and there are others, are the political costs and dangers of financial bailouts. That is, political scientists, and Tom Ferguson could probably speak to this more, have shown that financial bailouts often lead to polarization. That is, it moves to the extreme in the political system. And we all remember probably the Tea Party screaming and yelling about the bailouts of the great financial crisis. And I think it's pretty safe to say that the Tea Party set the tone for a lot of the politics that we are seeing now. So what lessons are learned? Well, I think we've come to a transition point, given how much systemic risk there is in our system now that we've been talking about all day. And the transition point is, well, what should we do? We have three choices, I think. Continue with these bailouts when the next big crisis comes along, number one. Number two, think of new ways to do bailouts that maybe reduce some of the problems, moral hazard, and so forth. For example, clawbacks, putting people who acted illegally in jail, as Jennifer Taub has written so well about. Or the third thing is just say no. No more bailouts. And if I have more time towards the end, I'll talk about what that might look like. Thank you.
Great. Thank you very much, Jerry. Okay, so what I got so far is we have this this tendency to repeat credit cycles with lots of incentive problems. When we do bailouts, we actually make it worse, potentially, because we're encouraging people to take similar or related risks going forward. And we might have to layer on top of that also political polarization, which then could feed back into allowing people to expand into new assets and perhaps rerun the cycle again. So for those who've been paying attention today, and if you haven't, go back and review the tape because it was all very, very compelling. But I think we've had at least three specific problems highlighted in terms of leading candidates to be either to be at the center of the next crisis, or if you think of Mark Zandi's exploding map of the galaxies, who's
accelerant?
I was going to say black hole, but we could say accelerant. Yes. Where is it going to start? So I've heard private credit. Concerns about that. Crypto, lots of concerns about that. And Anat Admati looking straight at me. Her book's called The Banker's New Clothes. So we have to just say good old-fashioned banking. Right. So that's three candidates. Just in terms of what you worry about now, if you were chairing the FSOC, for example, which you would never be allowed to do. Let me just be clear on that. What would be your priority? Let me start with that and then go to Jerry. So in terms of what's currently in your mind the most central risk you want to focus on?
Okay, again, within crypto, it's clearly stable coins, because now you have a new form of shadow deposits outside the regulated deposit system. Indeed, Hillary called it shadow banking 2.0 a couple years ago, and she was right. So these are now closing in on 300 billion, which is certainly not insignificant, and they claim that they could go several times that. I mean, this to me is a complete replay of the money market fund phenomenon in the 1970s and 80s, which disintermediated both banks and savings and loans and led to a very severe banking and S&L crisis that lasted from 1980 to 94 and wreaked a lot of havoc on the country, as Jennifer has told in her book, Other People's Houses. And that was, I mean, the money market funds were not the only thing, but they were a big accelerant because they drew funds out of the savings and loans and community banks and even the bigger ones, and essentially caused liquidity problems. So of course this is the Genius Act says that they can't pay interest, but there's no prohibition on payment of rewards by crypto exchanges or affiliates. So now you have Coinbase and Circle, who are business partners. Coinbase basically owns effectively Circle, and they get about 80% of the revenue Circle produces. And if you go to Coinbase and put your Circle USD coins there on their exchange, they pay you 4.1%. That's a money market return. So that's a disintermediation. You can go to Kraken and get 4%. Binance says they would offer you up to 10 or 11% if you put your USDCs on Binance. So we already have interest-paying stable coins. Now, will that be changed? I'm skeptical. The banks are trying to do it, but they're late to the game. They didn't do it when they should have. So this could be eating away at bank liquidity. And I mean, there's basically no regulation. The reserves are going to be inadequate. Oh, you can put your reserves in money market funds. So now you link. It's like having a convoy in World War II and putting chains across the boats. So if one goes down with the U-boat, it drags the other. So now we're going to link money market funds, and as Hillary said, other 40 Act funds together potentially with stable coins. Oh, you can put it in repos backed by treasuries, but the statute says you can rehypothecate those treasuries that are used as collateral. We saw that in the Lehman collapse. I mean, the collateral was pledged 7 or 8 times. They're going to allow that with stable coins. I mean, you can rehypothecate your treasury collateral. There's nothing to prohibit it. So this statute is filled with a host of enormous problems. Oh, you're going to let big tech firms, if you're X in a private big tech firm, you can get a stablecoin issuer tomorrow and put that with X money, and now you have a shadow bank operating in the big tech. If you're a publicly traded big tech firm, all you need to get is the certification review committee chaired by Secretary Bessent, with his good friends, the chair of the FDIC, and either the chair of the Fed or the vice chair for supervision to go along with you. And now suddenly every other public big tech can get into the banking business through stablecoins. That will be, first of all, it'll be frightening in terms of the surveillance power and the economic and financial power it would give big techs, and it will make them the new unchallenged too big to fail club. But it will again eat at the banking system and weaken it. So that's with crypto.
Okay. Let's why don't we that was very good and convincing.
Right.
But just look at the cameras a bit more when you say you, not me. Okay, I was also opposed
I'm sorry.
to the stable coins.
Pardon
But
me.
no, this is a bit of a. We play this a little bit like a poker game, Jerry. So Art has put stable coins on the table as with a pretty strong case for that being one of the accelerants. We'll come back to others. What have you got to beat that?
I don't think I have anything to beat that, but I do have something to add to it.
Yeah.
So there's all this talk about how the global systemically important banks aren't so important anymore, and we don't have to worry so much about them. And what I want to suggest is that's not right, that these banks are highly connected to other important components of our financial system. They're interconnected in dangerous ways. And just to give one example is with the non-bank financial institutions, the hedge funds and insurance companies and other institutions like that. I think the FSOC has to take into account clearly not only the GSIBs, but also the non-financial banking institutions, which they were supposed to do, but they didn't do. So just to give you just a few data points on this, and then I'll turn it back over to Art. So GSIBs fund a large fraction of NBFI liabilities and have significant common asset holdings with them. Non-bank financial institutions hold about 60% of U.S. financial assets. Banks provide critical funding via credit lines, term loans, securities financing, and derivative transactions. In 2023, banks held a large percentage of liabilities of NBFIs, 35% of GSEs and agencies, 25% equity rates, 25% broker-dealers, 15% finance companies, 10% ABS insurers. GSIBs via their prime brokers currently hold about 44% of hedge fund liabilities. So they are very interconnected, and anything that disrupts the non-bank financial institutions is going to disrupt the GSIBs as well, and then we're going to be back to the future. So keep them on the agenda.
Absolutely. In fact, when Mark Zandi put up this great graphic, you remember before in the last session, which showed the webs of connections, and he said it was very different now than in 2009. To me, actually, the centrality of the big banks seemed rather similar. Perhaps they moved a little bit left and right, but there were still big global banks more or less in the center of
And linked with
the
insurance
case.
companies. Now the insurance companies are linked together.
Well,
with
I
them,
was
right?
thinking AIG
Yeah.
when you said
Yeah,
insurance
yeah,
companies. So I'm not
right,
sure that's so different either.
Yeah.
Okay, so I think we've nailed crypto and the connections to the big banks. What else have you got, Art? Pile it on. Come on, pile it on. These guys want to hear the negatives.
We now have an explosion of crypto derivatives.
Yeah.
And there's nothing in the Genius Act that will prevent stablecoin issuers from offering crypto derivatives. We now have perpetual crypto options. You don't have to own the crypto. You own the perpetual option, and you get either the gain or loss. So it's a naked credit default swap. It's a synthetic CDO equivalent. So now we have crypto derivatives exploding. Oh, we just have multi-token ETFs now. Not just single token ETFs, but multi-token ETFs yesterday. So this is exploding. Jerry is absolutely right that, there's at least $2 trillion of bank loans out to NBFIs right now. If you look at the GSIBs, the only area in which the GSIBs have expanded their lending in the last 2 years is to NBFIs. They're not providing any new loans to anybody else, but NBFIs they're all in on. Let's look at subprime credit. So we have subprime auto credit, subprime credit card credit, student loans that are in terrible trouble. The banks are heavily exposed. So Tricolor, anybody here at Tricolor? They were a big subprime auto lender. They went down about a week ago. Oh, supposedly the banks are all walled off from this. Well, Fifth Third took a $200 million loss. JP Morgan Chase took a big loss. They didn't exactly say how big. I think Barclays might be exposed, or other banks. So again, remember that when New Century collapsed in February 2007, that was one of the big canaries in the coal mine for the subprime crisis. When they went down, all the banks that had warehouse lines of credit out to them took losses. That's where these losses are coming from. So the idea that the banks are shielded from this is bunk. The banks have written CLOs. We've heard that one before, right? Subprime business credit. So the whole last panel was on subprime corporate credit. So by my count, there's at least 5 trillion of that out there. And if one segment goes, they're all going, in my opinion. Decapitalization. We are decapitalizing. I'm sure Anat must be sleeping very restlessly these days because, let's bring the leverage ratio for GSIBs down to 3.5 to 4.25%. We at one point got them just about up to 7%, which was nowhere near enough, but now we're going to bring them down to 4. So we know there was a study by Andy Haldane and a co-author named Medeiros. They looked at 37 global banks that failed in the crisis. 5 of them failed with leverage ratios between 6 and 8. 8 more failed with leverage ratios between 4 and 6. So we are now setting ourselves up for failures of GSIBs because they won't be capitalized. They won't have any resilience when the next crisis comes.
So the last point, I believe, I'm sure, refers to the supplemental leverage ratio, which is a proposal, and you still have time to chime in and move public opinion, all of you, on this topic. Right?
It's tremendous.
All right. So my list right now is crypto derivatives, subprime credit, including autos and corporates both being called out separately, and the decapitalization of banks, on top of the point you already made, Jerry, about banks definitely not being shielded. What else you got?
Well, just to make everybody very optimistic about everything, I would say the global fracturing of cooperation. That is, we have a government that is in the process of dismantling global cooperation, pushing particular kinds of financial wares, crypto especially. And the last time we had crises, the bailouts were bad, but they were probably somewhat less bad as a result of various aspects of global cooperation, including swap arrangements and global cooperation around re-regulation and so forth. Well, that's gone. And so remember, we have this global market, and in the absence of global cooperation, the next crisis, the next crisis is likely to be perhaps much worse.
Okay, I got a great list here, and it's really quite compelling and really hard to resist logic. But here's an interesting countervailing observation, which is time since the last crisis. I remember meeting Dennis in probably 2009, and Dennis said exactly what he said then, as he said this morning, which is we're only halfway through. It's not even half time. And I thought at the time, well, look, better markets is going to do great things. And of course, it's going to not succeed because we go through this every 6 or 7 years. And here we are 17 years later, and we're still in business. We have not managed to stave it off. So here's my third last softball question. Or you get ready with your hardball questions, okay? My third softball question is, what happens next? And how do we get by ourselves another 6, 7, or 17 years? Other than making Dennis 17 years younger and starting over.
And I would only qualify what you said in that, in my view, we had a systemic crisis in 2020. And I'll explain why that was ready to happen. And we bailed everybody out. We bailed out even the corporate debt market and the fallen angel market, which we had not done before. So if you look at debt aggregates, these are very interesting. And Mark mentioned this. In 2007, if you look at the total public and private debt as a percentage of GDP in the United States, it was terrible. It was about 360%. In 2019, it had gotten back to about 330, and we're at 330 again. So we are not far from where we were in 2007. And 2019, when I wrote my book, I said, this is ready to blow. Of course, I didn't know the pandemic was coming. Globally, the same thing. If you look at 2007, it's worse. We were the world GDP. The world total public and private debt to GDP in 2007 was 275%. It was then 330% 320% in 2019. It's today 326. So we are worse off globally. So the problem is, and it gets back to bailout. Let's say I think the next crisis is within a year, maybe 2 at the outside. But I think we're doing so much insanity that it has to be closer than I originally thought. 6 months ago, the next crisis comes, and they say we have to bail out people. How would we do it? The U.S., the EU, UK are all well above 100% total government debt to GDP. We've had almost crises in all those debt markets over the last several years, and it's intensified. Remember, Mark said the BDC spiked up in April? That's because there was a treasury bond crisis. So where would the next bailouts come from? The Fed's balance sheet is bloated and nowhere near where it was either in 2007 or in 2019. The Fed's running an operating deficit because of their QE legacy. EU and the ECB and the Bank of England are worse. Japan had their crisis in the 90s, and they've never recovered. And their QE has taken them to 230% government debt to GDP. So there's no headspace for bailouts. As you say, they become too big to save. And if they're too big to save, then we're in the Great Depression. I don't see where the next set of bailouts could come from, even if we wanted to do them without the Treasury bond market. Everybody's saying we don't want your bonds, or you increase your interest rates by 2%, which would put us way over the edge.
Just to be clear, it wasn't me who first said too big to save. That was the Swiss taxpayer.
Yes.
Okay,
right.
Jerry, what's next? And including, I know you have strong views on whether or not another bailout wouldn't, in fact, be fiscally feasible.
Yeah. So first of all, why are we 17 years out? Well, it's for some of the reasons that I said there's been a lot of bailouts, but also let's not discount the fact that the crisis and Dodd-Frank did put a stop to this locomotive of deregulation. It slowed it down at least. And I think that has here and across the Atlantic, and I think that has had an impact as well. But in terms of bailouts, even if we could do bailouts, what I want to argue is perhaps we should just say no more bailouts. Now, what would that look like? And this is just going to take me a minute. What we need to do is protect communities. We need to penalize those who are responsible for taking the actions that led to the crisis, and we need to keep the plumbing going. That is, we need to keep the payment system going, and so forth. I think what we've learned from the last crises is that, at least in the United States and some other lucky countries, we still have a lot of fiscal space, maybe not perhaps to do a whole bailout of this whole system, but we have the fiscal space to keep the economy going, to protect communities. We saw that with COVID, with all of the actions that were taken by the government during the COVID crisis to protect communities. we have the fiscal space to do that, and in the United States and some other countries, we still do. To keep the plumbing going, well, I know that this was outlawed in the stable coin legislation, but Fed accounts, give everybody a Fed account to keep the plumbing going, so they can make their payments and so forth. Maybe combine them with the postal savings banks, as Mercer Barteron has been arguing for a long time. But there are ways to do that, and I know there are a lot of lawyers here who could figure out how we could get around the stablecoin law and let the Fed create Fed accounts. And finally, even if we have to prop up some of the financial institutions, which we might need to do, as I always tell my students, even if we have to save some of the banks, we do not have to save the bankers. That is, when the government intervened and bailed out General Motors, what did they do? They replaced the directors of General Motors. So that's a path that I think we should very strongly consider, and just say no to bailouts.
Okay, thanks. We got very clear statements from the podium. The floor is open. The microphone will, if you raise your hand, the microphone will magically appear in your hand. Once it appears, you're authorized to speak. Oh, and do please tell everybody, including online, who you are and where you work, if you want that to be mentioned in a public forum.
Yes.
Depending on your federal funding, maybe.
Yeah, Pat McCoy. I still haven't gone under the radar yet. There's a term that shall not be mentioned these days: climate risk. In the longer term, do you see that as a source of systemic risk?
Okay, we will collect 3 questions in groups of 3 because that's what the IMF always does. Go ahead.
Yes, this is Vicki Bogan from Duke University. When we think about kind of financial stability broadly, there's a school of thought that says financial stability is not possible until we solve some of the inequalities with respect to wealth and power. And so I would be interested to hear kind of your thoughts on that and how these inequalities are, in effect, a destabilizing force in the economy.
Thank you, Vicki. Let me take one more question over on the right side. Political balance in the room. Those on the left. We're taking one on the extreme right now. Seating chart-wise only. Pass the microphone down, please.
Thanks. So in the wake of the financial
your
crisis,
name and ID if you want to mention it.
Yeah.
Or you could also use a pseudonym I don't think we've quite reached those days, but maybe we have. Go ahead.
Lilith Fellows Granda, Senate Banking Committee. So following the financial crisis, when Congress stood up FSOC, it gave it the power to designate certain shadow banks as SIFIs and subject it to Federal Reserve regulation and supervision. I guess, do you guys have any thoughts on, what an FSOC 2.0 could look like? Any thoughts for reforms on Congress? Is it, the ability to write rules and enforce rules? Is it something else? Just any thoughts are very welcome.
All right, we've got 3 brilliant questions. Climate risk, deeper wealth and income inequalities, and FSOC 2.0. We only have 2.5 hours left in this session. So, Jerry, let me go to you first for succinct, pithy, witty answers addressing all 3 points.
Witty, I don't know, but I'll be short. I already am short, but I'll be shorter. That's taken from Robert Reich, anyway. So, climate risk. Who asked the climate risk? Yeah.
Pat.
Yes. In fact, we're already seeing it. I mean, a lot of the shocks that the financial system might experience, for example, will come from a higher than expected inflation because of excessive storms and droughts and so forth, which will lead the Federal Reserve, even under Trump, would lead the Federal Reserve to raise interest rates. And a big increase in interest rates is an example of something that can create financial stability. Banks and other financial institutions not taking into account climate risk, in particular, we already see with insurance companies, are potentially in significant trouble. So I think we could list many of these, and we should take that into account. In terms of the relationship between financial instability, wealth, and power, well, I think it goes in both directions, and I would say that the massive inequality of wealth and power is what's a major thing that's driving excessive risk-taking, lack of financial regulation because of this wealth is being used to, as Tom was talking about, buy off politicians and so forth. The massive inequality of wealth also is shifting consumption just to the very top. So there are many problems associated with it. And I think it's time for us to be a lot more explicit about that.
And FSOC 2.0 designation, or how you designed it?
And I'll skip on that.
Skip that. All right, good. Art.
Just briefly, I completely agree with Tom that I think climate risk is particularly a threat for insurance companies. I think insurance companies could well be the focus of the next systemic crisis, partly because of that. And of course, Pat knows far more than I do about that. But secondly, because you have so many captive insurance companies now that are controlled by private equity firms, and they are basically directing all their assets into private equity portfolio companies, illiquid and likely to have major losses. So I would be very concerned about insurance companies, which ties into the FSOC. I mean, absolutely, and Jeremy and Pat have written very persuasively on this. FSOC needs to get back in the business of designating systemically important non-bank financial institutions. That was their job. The whole idea of trying to bring some degree of control over shadow banking was to designate systemically important ones so they could be subject to the same enhanced prudential requirements that the Fed imposes on large banks, of course, before the decapitalization initiatives. But I mean, the whole idea was if they're big enough to require an AIG type intervention, they should be regulated like banks. And we have totally fallen down on that, and that needs to be revived. On the inequality point, I think two things I would say. One is everybody should have an access to a low-cost banking account. And I have begged my friends in the banking industry, if you want to fight off stable coins, if you want to fight off shadow deposits, you have to show that you're offering low-cost, reasonably accessible deposits to everybody, who can meet basic qualifications for them. If you don't do that, I mean, you heard the argument this morning. Well, this provides access to people who don't have access to banking accounts. And unfortunately, the banks have no answer to that because they won't follow my advice. We have Bank Now. Bank Now is a good program. Bank Now should be available to everybody. Why isn't it? The banking industry is shooting themselves in the foot, if not the head, by not embracing that. Second thing I would say is, and this is my Glass-Steagall point, when you put banks together with the securities firms and the securities markets, you then say the banks will live or die with the securities markets. What does that mean? Every time the securities market gets into trouble, you have to bail out and rescue the securities market in order to make sure that banks don't fail. So that's where the Greenspan put comes from. He realized, if I don't rescue the capital markets every time they start to go down, the banks are going to go with them. So now you have an asymmetric risk curve. You have a floor that the Fed put and shoot the moon. But that means you have to be able to play in the stock market to get that gain. So the people who have stock market investments make out like bandits. The people who don't have stock market investments get nothing. Well, why not sever that connection so actually capital markets could be markets again and not crony capital markets with a Fed floor underneath them? So we have to sever this link between banks and the stock markets. That, I think, is one of the real causes of this tremendous inequality that we're seeing.
Okay, great answers. The only commentary I would ask, get your hand up and the mic will come to you, is on your point about getting back in the business, FSOC, reviving FSOC. I don't think FSOC ever did any meaningful...
They had 4 designations that they all withdrew.
Yeah, so I think there's some things Congress can delegate to the executive branch, to agencies, and some things that clearly haven't worked this time. And the FSOC experiment was worth trying. It wasn't a bad idea.
It was very well intentioned, yes. It would have been better to start severing the shadow banking markets, but we didn't do that. Right.
It would have been better if Congress had taken action in a more detailed way, I think, in retrospect. Okay, who has the microphone? You have the power. Okay, Anna Marty. Yeah.
Stanford. In the new edition of our book, we go through bailouts forever. And so it's all nice and well to say no more bailouts. I'll start my talk with, Obama saying just that when he signed the Dodd-Frank Act. So it's just not really going to work. And the FSOC resignation, designation, what won't work?
Why isn't it really going to work?
Well, because
You mean politically or economically? We can't make it work.
Economically and politically, in terms of the institutions that are meant to do this. And Simon and I were on this Systemic Resolution Advisory Committee, and we were too skeptical, so we were kicked out at some point.
Too well
maybe
informed
because
is
of
what
that.
I tell the story.
Yeah. What do you say?
We were too well informed.
Yeah. Anyway, and the FSOC designation, should have meant that, we don't need them, because we would, regulate the systemic institutions out of existence, so we don't have too big to fail institutions. So it kind of meant to destroy itself.
And that actually happened to GE Capital.
Okay, let the questioner ask a question, then you can interrupt her afterwards.
I guess I would ask, exactly whether you have a scenario of no more bailout, just because I happened to look at there and I didn't really find it.
All right, great. That's the first question. I do want to take two more. The back, 2 rows back. Andy Green. Oh, sorry, or somebody who looks like Andy Green. I'm not saying it is Andy Green.
It is Andy Green. That's my name now, however you like it. So I want to put in a question for 2 lines and sort of 2 angles. One is, there was a crisis even before the 2008 financial crisis, Enron and WorldCom. And so I'd be remiss not to mention accounting, auditing, and all the importance of oversight and sort of honesty throughout the financial reporting. So I'm curious what you think, given the sort of changes and risks relating to data collection and macroeconomic, microeconomic, et cetera, information.
Quarterly reporting.
Well, you can add all the different questions you would like related to that. Second question is curious. Perhaps this is too long a question for this panel, but I'll just put a marker around the risk reduction that came from the Volcker rule, saying you can't make swing for the fence bets. It's been whacked at, whittled at, et cetera. But is that a principle that might be worth putting back on the table at some point?
Okay, one more question from Dennis, who has his own microphone. Go ahead, Dennis.
I just wanted to add for a discussion about bailouts that I think it's important to remember that in 2023, Democratic president, Democratic administration, Democratic appointees at the financial regulatory agencies over a weekend fully bailed out Silicon Valley Bank, Signature Bank, Silvergate was dealt with, and then First Republic was handed in a little bow to increase the profits of J.P. Morgan Chase. And if the United States, under a Democratic administration, did not give a nanosecond's thought to resolving a $200 billion bank, never mind a GSIB or anything else, isn't it fanciful to think that bailouts will not continue to be the reflex, recognizing that there is both constraints on the monetary and fiscal capacity to bail out at scale. And I think it's telling, and it gets back to the moral hazard problem, is literally the day the FDIC took over SVB, Silicon Valley Bank, the day it did it, its CEO was landing in Hawaii, going to his oceanfront estate that he paid for with the bonuses he got when he sold off the hedges that protected his portfolio in the years leading up to that under the nose of the regulators.
Is this the same CEO who testified to the Senate Banking Committee against?
Yes.
Yes.
And who was on the board of the San Francisco Fed.
Oh, right. I'm glad you mentioned that.
But the larger point is, I mean, I don't want to pick on anybody in the room here with his hand up over there named Jared. But
you get a whole hour at the end, Jared. But we'll go to you now. Yeah, microphone. Give the man a microphone.
I was in the room for better or worse, and I was going to say, I think I'm associating myself with your comments or not. So I've been in the room for a number of these bailouts. That's correlation, not causation. And I'm with Anat. I appreciate where you're saying, Jerry, where you're coming from. I especially thought that chunk of comments you made at the end about alternatives was really important. But I think I have a fairly good sense of judgment about all the things we're talking about, and then adding macroeconomic consequences on top of that. And we were really worried that we were going to see really damaging economic impacts. And I think when you talk about the cost of bailouts, which you beautifully articulated, you have to also think about the benefits and how many points of unemployment you'd be willing to give up. Because that's the way, at least I think we've thought about it, pretty correctly. Now, you mentioned, what if we did fiscal policy instead? That takes a lot longer. The political economy is way more challenging, which is kind of interesting because people hate bailouts too. But the fact is that you can get Congress to do that more quickly than you can get them to actually help communities.
Can I respond to that?
Yeah, yes. So of course you can. So I'm going to arbitrarily allocate the remaining 9.5 minutes, 5 of them to Jerry to address these concerns. Of course, he's not running away, so he can talk to you more afterwards as well. And then I give the remaining time to Art to talk about, to clean up a little bit on the other points.
Okay, I don't need 5 minutes, but let me just say this. Yes, first of all, it is going to be the reflex for sure, and there are good reasons why the government has undertaken some of these bailouts for all the reasons that you said and that you suggested, mostly what you said. But what I'm suggesting is that our approach here, which I endorse and been a little bit involved in, is to say the solution is better regulation. Prevention is better, than the cure. Right. But if you think no bailouts is politically infeasible, I'm saying to you, and we've talked about it all day, regulation right now in the next couple, 3-4 years, sufficient to stop this train wreck is also pretty politically unlikely. Right. So who's being more utopian? I'm not sure. I'm not sure who is.
Okay.
So, but
those are fighting words, utopian. I thought what you were saying, which was anticipating it ahead of these guys, was actually if you build bigger, better lifeboats for things you care about, like communities.
Yes, I was just going to say that.
Go there, say it.
But you said you have a better term. What we need is bigger, better lifeboats. Okay. So you asked me what's the plan. I don't have a full plan, but if we take some of the best from the New Deal, the HOLC, homeowners HOLC
Loan corporation.
For housing, and some of the other actions of the New Deal, right? And we take some of the better actions from the COVID response. These were all fiscal policies, some of which got into people's hands very quickly, right? The underwriting of people's bank accounts and loans and this and that happened very quickly during the COVID thing. So we have examples of that, but we also need to have we need to have the plumbing. We need to have the public accounts. What do you call them? The Fed accounts, or you were talking about the
bank now.
The bank now.
Accessible bank accounts.
So that you can get money into people's accounts quickly, keep them whole. So we have historical precedents. I do not have a full plan, but I will have a much better plan around 7 months from now, because this is exactly what I'm trying to do, is develop this better lifeboats and whatever was it you called them. So we can at least try to make the argument to people, no more bailouts, because who are we going to be bailing out? We're going to be bailing out, can I say this? Trump and his family and his crypto friends. The entire U.S. government, the Treasury and the Federal Reserve, which they're trying to get control over, is going to be just an ATM machine for them. And is that what we want? I don't think so.
If I could, I'm concerned we only have 7 months to sort this out, Jerry. That's a little prediction. But I would like to nominate for your consideration on that list to bring back properly the Transaction Account Guarantee Program, the TAG program, which was used by the FDIC in the fall of 2008. So you guarantee all transaction accounts for businesses. You can either do this on an ongoing basis and have them pay insurance, or you can bring it in. You can zero interest accounts. Thank you. Or you can bring it in when the disaster hits, which is harder to do now under Dodd-Frank, unfortunately. And I think, Jerry, what's nice about that is it's not the backup plumbing, but it does say Silicon Valley Bank can go down. All of those depositors have to wait to get paid out. They probably would have been paid 90 to 95 cents in the dollar. They get half their money back in 2 weeks. They have to live with that, sure. But then if you guaranteed all the transaction accounts across all the rest of the banking system, at least temporarily, there's less of a run, and there's no run to JP Morgan, and that takes that off the table. So it's not exactly what you want, but it's beyond. It is addressing the point of the credible threat, which I think is we all agree is yes. It's a yes, okay. It's a bailout, fine, but it's a different kind of bailout. All right. Anyway, Art, you have a couple of more minutes to.
I wanted to go back to
cleanup.
Andy because I think the Enron and WorldCom episodes were incredibly important because the banks were the chief enablers. So you saw with Enron and WorldCom what was coming in 2007. I tried to say at the time, this is the canary in the coal mine. This shows you what happens when you put banks together with Wall Street. You get Enron and WorldCom. Now, he mentioned, right, that was an accounting fraud and failure. Of course, Arthur Andersen evaporated. They were prosecuted, went down. And then we said, okay, well, the remaining four are too big to fail, so we'll let them get away with anything. So it just turns out KPMG audited Silicon Valley Bank, Signature, and First Republic, failed on all three. What's going to happen to them? That just came out. That's a huge question. If auditors cannot be, see, this is as you say, this is a question of accountability. Can bank executives be held accountable? Can auditors be held accountable? Could regulators be held accountable if they clearly did something wrong? We've had no accountability for a long, long time. Actually, there was some in Enron and WorldCom, and then the Supreme Court stepped in and said there's no more aiding and abetting liability under the 10b-5, which killed Enron and WorldCom cases from then on. So accountability is enormous. I wanted to speak about Dennis on the 2023. So there were two reasons I believe why, and I'd be glad to get confirmation or no. Circle held 10% of the reserves at Silicon Valley Bank. Circle was melting down. They went to 86 cents on the dollar. If they had not rescued Silicon Valley Bank, the whole crypto ecosystem could have collapsed at that point. The second thing was, it wasn't just those 3 or 4 banks that were underwater. At the end of 2023, banks were $630 billion underwater on their held-to-maturity government securities portfolios, of which more than $300 billion was at the biggest banks. And the Fed set up this bank term funding program where they made loans equal to 100% of the par value with no obligation for the banks to suffer any losses. The Fed took the whole risk of all the losses. So that was another enormous subsidy and bailout. So, you know, we keep compounding the same lesson over and over and over again. And again, it seems to me that as long as you marry your banking transactional payment system to your capital markets, it will continue thus, because if one gets in trouble, the other gets in trouble. 1987, that was very interesting. The stock market crash occurs. You know, big problems at all the broker dealers. The Fed goes to the banks and says, would you make a bunch of emergency loans to the broker dealers to help them out? And the banks said yes, because they weren't exposed. So the banks were able to help bail out the broker dealers. 2007, all the broker dealers were the big ones that were either inside banks or linked to banks, and nobody could help anybody, and we had to bail out everyone. I mean, it seems so. And we talked about monetary policy. How can you get control of monetary policy unless you say all deposits must be in banks? No more money market funds outside banks, no stable coins outside banks. If every deposit is in a bank, hey, guess what? Reserve requirements work. The Fed has monetary policy control again. We've given all this away. For what purpose? To do infernal cycles of boom, bust, and bailout. I mean, isn't insanity doing the same thing over and over and expecting a different result? I mean,
that's one definition.
That's what I would end with.
All right. But we still have a minute and 20 seconds. So, right. Jerry, final words.
If there are any more questions.
One last question or comment, or yes, please, in the third row here.
So I was coming of age during the Great Financial Crisis, and
what's your name?
Jenna. I'm Jenna Pokorny, representing FINRA, and I think a lot of people in my generation, elder Gen Z, younger millennials, haven't really experienced a financial crisis, and I think we all in this room recognize that there's a lot of risk. But I think people of my generation who are not as informed would look at the stock market and say, stock market's at all-time highs, it's time to jump in. How would you just advice as to how would you, if you were in my shoes talking to my friends who don't have all the knowledge in this room, how would you talk about systemic risk and caution average investors and your friends and family on these topics?
5 seconds.
Tell them to watch the Frontline. This is what I do with my students. Watch the Frontline documentary on the Great Financial Crisis. It's a 4 or 5 episode documentary. It's fabulous. My students who are younger than you really come away white-faced because they did not understand what happened.
We may need a 3-minute version to break through to that. Sorry, yeah, that wasn't your generation. Okay.
Mark Twain said, if you put all your eggs in one basket, you better watch that basket. So what we have done is to put all our eggs in that one basket, big financial conglomerates, and we're not watching the basket anymore. So either you better watch the basket like a public utility, or you better separate the basket. Oh, sorry about that. You have to separate the basket.
J.K. Galbraith's The Great Crash.
Yes.
Sometimes the old books are the best books. He's not here today. He never asked me to plug his book, but it's a slim volume, super readable, takes you through how the boom, particularly that particular boom, unraveled. Thank you. I think we're getting the shepherd's
thank you very
hook
much.
here.
I will say it was a fantastic panel that ended with a horrible answer. That generation needs a 30-second TikTok answer, not a 4-part documentary in a book.
I said 3 minutes.
My God, right?
I was being polite.
If you want, they say, look, the stock market's going up. Let's jump in the pool. Would you jump in the ocean before knowing if there were sharks there? I don't know. Put that on the TikTok. But you guys are fabulous. Thank you very much. And we're going to take a quick 5-minute break and go to the next panel.